I started my investing journey a few years ago while still being a teenager. I've read dozens of books, read articles, watched videos and had good and bad experiences. I've also talked to people who told me that investing was great, while others told me that investing was bad. Alright, let's make it simple. Here is what I learned. Hi, Jarod here, and today let's talk about investing. So, for each part of the video, I will tell you what mistakes I've made and I was making, what I've learned, and also how to avoid them. Okay, this is an important thing to know. People can make this mistake, especially when they start in the investing world. I myself was doing it. I truly thought that the price to buy of, let's say, Apple reflected its real value. So, if the price was going up, then it means that Apple was a better company, so more customers, better products, more sales and increasing net income. Or the opposite. So if the stock price was going down, it meant that Microsoft was a bad company, or Apple a bad company, with decreasing sales, bad money management, and thus decreasing net income. In other words, I thought that the price equaled the value of Apple. Well, this can be true sometimes. The market is at its fair value. Everyone knows that Apple is a great company with huge advantages and so on. But sometimes the market does not reflect the real value of a company at all. To give you a better idea, here are the numbers related to Apple. You can clearly see that it has an increase in net income over the last 5 years, so roughly 19% a year. On average, the company has also been paying dividends continuously for more than 33 years now, with a current dividend yield of roughly 0.61%. And moreover, it has a good increasing return on capital of 23% a year on average. So, those numbers only are a green light for a company like Apple. It shows that the company is already a big ship that is hard to move. Moreover, Apple has a huge competitive advantage compared to its competitors like Microsoft, Intel, and so on. And here's Apple's price over the last 5 years. And since the beginning of this year, it went relatively down. It lost 18% of its value, from $182 a share to $150 right now. And here's Apple's net income over the past 5 years. And as you can see, while the company is still highly profitable, its price is plummeting. But did the company sell 19% fewer products and services than last year? Nope, it did not. This is simply due to random investors selling their shares for so many different reasons. Because everyone is doing so they get scared, they need their invested money, and so on. To give you a broader view of the market, here's the S&P 500, so the performance of the 500 biggest US companies. And the index lost 17% of its value. But did the 500 biggest US companies sell 17% fewer products and services than last year? Again, nope, they did not. Alright, here's a graph of the S&P 500, so again, the index that tracks the 500 biggest US companies. And here's a question for you. What do you think is the future performance of the 500 biggest US companies the following year? To help you, here are the 3 possibilities. First, it will go down by 30%, it will go up by 30%, or it will stay about the same as it is now. In fact, it went significantly down. And what if you thought it would go up and decided to invest right at the top? You might be right or you might be wrong. But the truth is that even if you think that you can always pick the right answer, no one can predict the stock market. And as Warren Buffett said, time in the market is more important than timing the market. Alright, I have some research for you. And for example, let's take a broader view of the market with the S&P 500. Yes, again, you have many possibilities when it comes to investing in the stock market. And let's say you invested $2,000 annually from 2001 to 2020. First, you simply do not invest at all. Your $2,000 each year is worth now $38K in 2020. But thanks to inflation, your $38K is now worth $25K. Secondly, you're not lucky at all. Each time you invest your $2,000 at the worst moment possible, which will bring you $121K. Still, not bad for someone who's not lucky. And thirdly, you use the dollar cost averaging approach. This allows you to smooth your investment, so investing a fraction each month. So, instead of investing your $2,000 at once, you decide to split them each month, so roughly $166 a month. In fact, this would have returned $134K in 2020. And finally, you can be the perfect market timer. So you've always invested $2,000 when the market was its lowest point each year. In fact, this would make you $150K in 2020. And there you have it. we should not try to time the market, so waiting for the best moment to enter, simply because we cannot predict it. No one can. And I think, in my opinion, it is not worth to even try. So, the best way is to simply invest a small amount each and every month. Okay then, should I diversify? You've probably heard about the saying, do not put all your eggs in one basket. This single quote says it all. This advice means that we should not concentrate all our efforts and resources in one area, as we could lose everything. And as investors, we should not put all our capital into only one single stock. Sometimes, this stock could go significantly down, losing 10 or even 30% of its value. That might not be a problem if you think in the long term, and you've done enough research to know that this company is still highly profitable today. But let's say you need this invested money in an emergency, and you can quickly see that this becomes a big problem. So, what are the solutions? And where to even diversify? Well, first, whatever you do, always keep some cash. There probably aren't any golden rules when it comes to how much you should save a month. It depends on your needs and so on. But always keep in mind that the money you invest is the money you're willing to lose forever. Okay, next. You could diversify across industries. The only reason is that the industries are not 100% correlated. So, sometimes one goes up and the other goes down. Could be tech stocks, energy stocks, as well as healthcare and consumer staples. For instance, the energy and healthcare industries are not always correlated, which is good news. During the pandemic, Johnson & Johnson went up, while Chevron went down, losing 25% of its value. Or Procter & Gamble went significantly up, plus 40%, while Caterpillar went down, like minus 40%. Simply because everyone still needs to buy daily necessity products, whereas no one could build anything during the 2020 COVID outbreak. You can also diversify across market caps, so small cap companies, mid cap as well as large cap, and mega cap companies. It ranges from less than $300 million to more than $200 billion in market cap valuation. Large cap companies are typically older and well established, and they usually pay reliable dividends. Could be Starbucks, PayPal, Apple, and Walmart, for instance, which have strong competitive advantages compared to its competitors, and so on. Moreover, feel free to invest in different countries, as this will allow you to put your eggs in different markets, so different opportunities, ups and downs and in-betweens, and so on. And finally, I would recommend investing not only in the stock market. It could be gold, cryptos and real estate, for instance. As always, they are not 100% correlated, so this can prevent big losses when the stock market is down. There you have it. For instance, I diversified my portfolio across sectors, market cap and countries, and I also own fractions of real estate, Bitcoin and Ethereum. The fourth mistake I was making is being emotional about the stock market and money in general. I didn't really like to see my stocks turning red, then green, then red again. I was almost thinking that my investment was bad, and well, in fact, I was irrational. I was seeing market downturns as bad, as negative, as something to avoid, and well, I was wrong. Instead, we should see market downturns as opportunities rather than a drawback. From the beginning of 2022 to almost the end now, the stock market went down. But instead of selling everything, I've started a series on YouTube called Invest With Me, where I invest in front of you at the beginning of each month. And this will allow me to see how I progress over time, what I was doing wrong, and what I can improve also. And above all, this allows you to learn and invest at the same time as I do. Then, I was also paying too much attention to social media and news in general. I used to receive notifications from Yahoo Finance, for instance, like what my stocks were doing each day, what was happening in the financial world, and what went up and down. Well, this quickly became overwhelming, and I've switched off the notifications for this app. This was the opposite of what investing is all about, which is to think in the long term. I also stopped watching the news anymore. If it's something really worth knowing, then my friends will probably tell me. But that's it, I guess. I now remind myself that news is noise. Take CNBC, for example. Whether it is on the website or the Instagram account, they will remind you each day that the market is about to collapse, or that you should invest right now to profit for the next bull run. Well, again, no one can predict the stock market, so we better switch off the news and start learning about investing. Which brings us to how to learn about investing. And the fifth and last error I used to make about investing is to think that I knew everything. Or sometimes I thought that knowing the basic knowledge is kind of enough. You know, it's like reading the summary of a book online, or just a few quotes. Well, it can be enough for some people, but knowing more might change your approach to investing. It could make you invest in an X or Y company, talked about in a book. It might shape your decisions without you even knowing it. So, first of all, I would recommend reading books. Could be anything you have in mind. Recommended books by family and friends, on website too. Anyway, and by the way, the first book I read about finance was Rich Dad, Poor Dad by Robert Kiyosaki, and I discovered it by simply googling books about finance. Then I would also recommend podcasts. These are a great way to keep learning through YouTube, Spotify, and so on. And finally, these channels help me start and understand the investing world. Combine the three and you will be good to go and find endless investing lessons and content. Alright, there you have it. 5 key errors I was making in the investing world and how to solve them. And if you have enjoyed this video, then you will like this one, where I talk about a myth about investments, or this one if you wanna know more about how to stop spending and invest more. Thanks so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.